All right, what's going on, everyone? Good morning. Welcome to Stocks and Coffee. This is Paul Singh here. Give me a little shout out as usual. A lot of you regulars know the drill. I want to know what you're drinking, where you're from, anything else you want to talk about. Tim, what's going on? Got his usual dark roast in Chicago. Will, what's going on in Jacksonville? Kona Coffee. Brian's from Vancouver. Richard's got the donut shop coffee. I'm guessing that's Keurig, right? Keurig has a donut shop. Daniel, uh, LSF, Laird Superfood Creamer. I think I've seen that before. That's one of those super healthy ones, right? I don't do any of the mushroom healthy coffees. I just want my wake me up and taste good. From Arkansas, we got Richard. What's going on? We got if I'm saying your name right, Rise from UK. First internet live. We had Vancouver. We've got some international members in here. Timothy, what's going on? Duncan, love Duncan. From Chicago. This thing's moving fast. There's a bunch of you in here. I hope I don't miss anybody. Brian, what's going on from Florida? Joe from Canada. We've got Rise from Wales drinking his green tea, another healthy morning drinker. Actually, if you're in Wales, it's not morning now. We got black coffee from Kansas City. That's Steve. Kat, what's going on? Drinking Pete's. We've got Steve from Boston. Brent's drinking some old school Mr. Coffee drip coffee. That's I think what my dad drinks. Aaron, what's going on? Drinking the Nespresso. Adam, also super healthy with the Laird. We've got, I hope I'm saying your name right, Zerona, for drinking some Costa Rican coffee. Arod, what's going on from Chicago? Jatine from Canada. We've got Trey from New York. Gorank from New Jersey, the cold brew. I'm not into the cold brews. I'll drink iced coffee, not the cold brews for some reason. Birdman, what's going on? Dan, Joy from LA. All right, big turnout today. Lots going on in the market. Lots to talk about here. We'll get out of here pretty quick so we can get to our weekends. But still a lot to talk about here. Let's start with our usual market analysis and let's do a little bit of a review. Since we're up here now, almost back on trend. And if we pull this thing out, notice here, if we, things look a lot better when we pull these things out on the long-term charts, unless there's a really serious meltdown, which there kind of was. But you can see here, we're essentially in this big old uptrend since 2008. That's crazy to think because through this period, we've been through so many big market dips. Of course, there was the pandemic, which broke down very deep here, but also recovered so quickly that it doesn't really feel like it messed up the trend at all. And that's kind of the same thing that is happening now. We had a very deep pullback. Some would call it a bear market pullback, depending on what your definition is. I don't care what the definition of a bear market is. To me, if something happens in a week or two, that's not really a bear market. A bear market has to cause some pain for a period of time. This was a bear market in here. So let's review what's gone on here, and we can see if we go back to February when we made the highs, and I think we talked about this in the last Stocks and Coffee, that we had our warning signs here back in February when the S&P 500, and you guys know when we start our market analysis, we use the S&P 500, we use the Qs, and we use IWM to kind of get a gauge of the market. That, just by doing those, we're going over about 2,600 stocks, 500 in S&P 500, 100 in the NASDAQ, and then depending on which small cap ETF you're looking at, either 1,000 to 2,000 stocks in there. So a lot of stocks gives you a good broad range of the overall market, but it's not perfect. We know that. So we use some other tools to really gauge what's going on under the hood. And we were getting some warning signals from when S&P 500 was making all-time highs, when if you went on to CNBC, there was a little bit of euphoria. All these professionals are coming in and talking about how great the market is. We knew that there were some warnings under the hood, and we were talking about them. We were already starting to get a little bit cautious. We were trading through it, but with more caution. And that was because, and if you guys have either been in the swing report or you've been attending these stocks and coffees, you knew it at this time. We had some market breadth concerns. And if we look at RSP, again, you guys know the drill, S&P 500 is not equally weighted. RSP is the 500 stocks in the S&P 500. Apple alone, I think, is 3%. And in the top 10 holdings, right now are historically high. They make up about 35% of the index. So you're not getting a good idea of the whole thing. Now look at where SPY was here when it was breaking to all-time highs in February. And then if you look at RSP, this is what's called a negative divergence. RSP was not. If RSP was keeping pace with SPY, this is the same 500 stocks. It's just weighted equally. So we're getting a better broad-based understanding of what's going on with these 500 stocks. And we saw RSP was not up here like SPY was. It was not making that high. And we could look at IWM, small caps, and we were seeing the same thing. Was not making a high, was not keeping pace with SP 500. There are other breadth indicators. One of my favorites is just looking at my own watch list. And when I see not as many good stocks to trade, that's a clue to me that something's going on here. If you looked at new highs versus new lows, when the market's making new highs, you expect to see a lot of that. We weren't seeing a lot of that. So there was some cause for concern there, and it played out. Right after we made the high, the market pulled back very quickly, right? And then there started, and the initial pullback was not necessarily because of tariffs. Tariffs hit more around here. I don't remember the exact dates where we really got serious about the tariff stuff. But initially, it was because of fears of the Fed. And this is all kind of relating together. It's all about inflation, right? That's what tariffs are about. That's why we care about tariffs. That's why we care about what the Fed is doing. And here we were starting to see some hotter numbers related to the Fed, and then some Fed heads coming out and saying some stuff that the market didn't like. That caused the initial kind of meltdown here. We got the reflex bounce, and we were, of course, very cautious through this period. And then this is when the tariff stuff really hit and went into overdrive, and we got this push down. We were very cautious. We took some trades through this period, but we got very cautious. And then through this period here, we're basically sitting on our hands, doing nothing. And this is where you have to be careful as a swing trader. There's this tendency when the markets get volatile, we get volatile too. You do not want to get volatile with the market. And you have to know, okay, this is where my edge is, and it's all right to just be in cash or to slow down or take less risk, take fewer trades. And that's essentially what we're doing here. And then we talked about it, I think, in coffee and stocks here, when we got one of these two big moves here, that this was feeling like capitulation. And we even went, even though these were ugly candles, we said we were going to go from bearish to market neutral and maybe even slightly bullish. And we started to build some positions in here. And it's scary to do when you have this kind of volatility, but you can manage that with risk, so you can sleep at night, not taking too many positions, knowing that even if you get stopped out, it's not going to hit you too hard. And then the idea was here, every resistance level that gets taken out, we slowly get a little more bullish. And if you guys have any questions, post them in the chat here. So we had the 90 EMA here. It was the first major resistance level. We wanted to see the market hold that. There was some back and forth here, and then we really got that gap up here where it was a good signal. Our next resistance level was the high that was made on this reversal candle, and we can see we broke that through that here. We had an open gap here, and then late last week we had the break of the 50-day moving average, and now we are getting very bullish as more of these levels clear, and not just these levels, because of course, as we just discussed, SPY is not the be-all end-all for everything. We have to look at our market breadth indicators. Market breadth indicators were improving. My favorite again is I was seeing more great setups to trade. RSP was improving. Look at how RSP caught up to the S&P 500. IWM, while not in the overall context of the pattern catching up, the percentage gain through this period was very strong. Another good market breadth indicator. And another really strong indicator that honestly surprised me, I wasn't expecting this, and we talked about this a few weeks ago in Stocks and Coffee, when earnings season was getting going. We talked about being worried about this earnings season, and we didn't really care about whether companies beat their expectation on revenues or earnings. What we really cared about was guidances going forward, and just knowing historically what companies do. Our expectation was companies were going to warn. And the reason they do that is because quarter to quarter, they want to beat expectations, right? So if the market is expecting one thing, they want to obviously beat it. And if those expectations are set high, they can have, you see this all the time where a company will have record revenues, record earnings, everything looks fantastic, but the expectations were so high that they didn't meet them, and the stock will still do poorly, even though the company itself is doing great. So they will try to, if they're concerned about anything, they'll try to create lower expectations so next quarter they can beat them easier. And my expectation was that that's what a lot of these companies were going to do because of all the tariff stuff, because of inflation, and so on, and some worries like that. The opposite happened. A lot of these some companies have warned, but not the way I would have expected. And a lot of companies are coming out and saying, Netflix came out and said, tariffs don't matter to us. Inflation doesn't matter to us. We're tariff and inflation proof. Everyone is going to want our service no matter what. And then Netflix exploded. The banks essentially said the same thing, and the banks had very good earnings, and then so on and so forth. And I think that kind of set a kind of tone, and then we haven't seen much of that. And I think that has really helped the market as well. And of course, the easing of the tariff talk that has obviously had a big impact in that. And on top of that, the inflation numbers are getting a little better. So all of that combined, also combined with the fact that the market was just so extended to the downside and we had this capitulation event, all that has led to this big move. And now we're almost out of the woods in terms of the overall pattern. Of course, news events can come and we can't control that. But just from a purely price action point and the way we do technical analysis, we're almost right back on trend. And notice here, looking very much like kind of a miniature version of what happened during the scary pandemic move, right? Where we had this huge decline to the downside and then a very strong move to the upside that took out all these resistance levels and got back, once it got back up over the 200-day moving average, was just back on trend, right? And that's exactly where we are now. Remember when we were comparing to the 2022 top, and I actually have an article in here on my site, pauljsingh.com, and you guys should check this one out. Is SPY signaling a repeat of the 2022 bear market top? And we talked about that here as well. We weren't making any predictions. We were just saying this looks exactly like we looked here. And we talked about wanting to analyze this as the market and price action played out. Are we going to get this or are we going to get this? And so far, we're getting this. And so you don't want to make predictions. You want to adapt to what's happening. And we adapted to the fact that we had this big move to the downside. The bounce came in here as well, but then it failed. And right now it looks like we're not failing. And we're essentially right here. If we look at where the 2020 bounce happened, we're about right here right now. And if we were to look here, we're about right here right now on this move. We still could here fail if some, I don't know, if some China news came out or if Trump got backtracked and went aggressive on tariffs again. If the Fed comes out and says, not only are we going to continue to pause rates, we're going to raise rates because inflation's out of control or something like that, the market would surely then get into bear market mode. But for now, we don't have to worry about that. We can't sit here and fear what we think there's a, I don't know, 20% possibility could happen. We just play and manage our risk here. So for now, we're essentially looking at this as it's like the 2020 move. And of course, we can adapt very quickly if something were to change. So what we're watching for now, first of all, the market is very extended. So we've had a lot of success through this period, trading it aggressively, but now I think it's a time to slow down. We've taken a lot of profits during this range right here in a bunch of stocks, PLTR, my mind's blanking now, DoorDash, Hood, a few other stocks here. And we actually added one position on Friday. But this is a good time to start to slow down a little bit. Feels like the market might consolidate here early next week because we're so extended. 9 days of the upside is very rare. So the market is ready for a little consolidation, which would be healthy. Don't fear it if the market starts to pull back here. We want that. We want a little back and forth here before potentially we get that break of the 200-day moving average, which we're going to be watching for very closely. If we get back up over the 200-day moving average, the market is essentially back on this long-term uptrend. So Very strong market right now. But again, that could change very quickly. So we'll keep an eye on it and be ready to adapt. So that's a review of what has happened and where we are now. And our game plan going forward is essentially to open things up. We started through this period probably getting a little more aggressive than most people were, but we were still cautious in managing our risk. And as the market started to prove, we've gotten more and more aggressive, taking more and more bullish trades. The game plan right now is to, and we've got positions on still, so if the market were to ramp, we still get to participate in it. But in terms of adding new positions, I would say be a little cautious here. If you do add positions, maybe manage it with a little less risk. Watch for a little back and forth, and then if we get a break of the 200-day moving average, get aggressive, because then there's not really another resistance level until the all-time high. So that would indicate a very strong market. Continue to watch your market breadth indicators and open up the universe of stocks now. So when we started through this, you guys remember, we talked about a very specific setup we were looking for. I narrowed my watch list down, and the only setup I was really trading, and it has been very effective, is taking those relative strength stocks that specifically were strong before the meltdown and were market leaders before the meltdown. We don't usually dig too deep into fundamentals, but we were looking at this chart here, growth fundamentals, and making sure they had good earnings and growth trends. Those were the ones that would happen to be showing the most relative strength and were in very strong trends. So we were looking for that, and then held up during the pullback very well. And we're getting already kind of beating the market to those continuation patterns and hitting those resistance levels. So those were the type of stocks we were specifically looking at, about 15 to 20 of them, and that was it. A very narrow list that we could just go to and trade through. Now I think it's time you can open it up to more stocks, to more industries that are starting to come alive. AI is starting to come alive. Quantum computing, and these things were lagging. They got hit really hard during the pullback. Retail stocks, which got hit very hard. Of course, consumer discretionary areas, when the market is worried about inflation and the consumer and how much the consumer is going to spend, consumer discretionary gets hit very hard. So retail stocks were hit very hard. Now they're coming back. So we can trade setups related to those as well. And we had also taken big tech stocks off the table. They've been leaders for a long time, but during the pullback, they got hit very hard. There was money flow out of that area. But now that most of these guys, except for NVIDIA, have reported earnings, and almost all of them have reacted very well, that big tech is back on the table. And let's do a quick review of that. So we've got the review of the market. We know we're trading more setups now. Continuation in terms of widening strategy, continuation patterns in various forms, whatever type of continuation patterns you trade. Essentially continuation patterns are stocks that have been in trends, have pullbacks, and now you trade those pullbacks, either on breaks of highs or on the pullback to support levels. And there's various types of patterns you can trade related to that. Earnings-based setups, and those of you guys who are following me for a while know all the earnings types of setups we trade. So all of these stocks that have earnings, we track the breakouts. Of course, we have the big tech breakouts just in our big tech list, but here's Q2 earnings here, and you can see we've got about 35 stocks. There's probably 6 or 7 I still need to add to it, but these are all earnings breakouts that we're tracking for potential setups as well. So we've got the earnings plays, and honestly, I wasn't expecting to do a lot of earnings plays this quarter. I didn't think earnings would be this good, but we're getting a lot of breakouts. And then stocks that, not breakouts in terms of 5-10% breakouts, but stocks that are just starting to break out of ranges. They have been in this range for a while, and now we're starting to break out of them and ready to make their moves. And we have setups related to those that I think we can be trading now. So we can essentially open up the universe of stocks and setups that we're trading right now, instead of that narrow list we were looking at in here. Already talked about my earnings commentary. Again, better than expected, both in terms of numbers and guidance. Now let's start with some stocks on watch. We'll do the big tech review. They've almost all reported earnings now, and there's 4 or 5 of them that are very interesting for entries. And if the market holds up, I will probably be adding a couple next week. Before I do that, let's get to some of your questions here. Brent's asking, do you think you'll see SPY do a micro pullback next week because it's extended right now? Yeah, I don't, we can't really make predictions. You don't know what's going to happen. And a lot of times the market does the unexpected. But if I were to guess, and honestly, what I'm hoping for is, we always hope for the market to be going up, right? That's not always a good thing. We're so extended now, this huge, in terms of percentage gain, this is a huge percentage gain, 9 days in a row of up days. We would like to see some consolidation here. And I know some traders, it gets a little boring when that happens. You guys sit there and wait, maybe a couple of days, but I would like to see next week start with just some back and forth here before the next run up and maybe a remount of the 200-day moving average. And then we get aggressive. Lion Trades is asking, what would be a good clue about when trend is more likely established and getting out of massive volatility so we can swing trade more comfortable? First of all, I know this idea of wanting to be comfortable, and of course it's much easier in that regard, but we've had so much opportunity in this volatility, so don't be afraid to trade through volatility as long as you're managing risk. And that's the key to comfortability, is know how to manage your risk. That being said, your specific question, when you feel really comfortable, like we alluded to, essentially, I already love the fact that market breadth has really improved. And notice here, volatility is improving as well. Look at the intraday volatility. As we've been moving up 9 days in a row, candles are getting tighter, right? We're not seeing these crazy intraday moves where we're up and down huge amounts, right? So volatility is already lessening, which obviously makes it more comfortable. And in terms of like the point where I feel like, okay, we're back on trend, everything's really good, I would love to see a little bit of consolidation and then getting up over the 200-day moving average. And the institutions watch the 200-day moving average. It was created by the 200-day moving average. Back in the 80s, Goldman Sachs traders basically developed the idea of the 200-day moving average. So everyone's watching this. Everyone feels more comfortable when we're back up over that level. And you'll start to see, it's almost, I wouldn't say nothing's guaranteed, close to a guarantee that if we get up over the 200-day moving average, volume's going to increase and we're going to see money pouring in if we get back up over that level. So that's where I would feel really comfortable. And as long as market breadth continues to stay where it is right now. Juan's asking, in your experience, when the market gets this many green candles in a row, I find it hard to open new positions. Yeah. So you have to think of market and you have to also think of your own stocks, right? So when the market is this extended, your overall approach is, okay, I need to slow down now. I've been bullish. I've taken all these trades. Let me take some profits. And by taking some profits off on other positions, it leaves some room to open some new positions, even though the market is extended. And what I look for is stocks that are not as extended as the market. So for example, on Friday, we added Okta. Now, Okta, if you look at it from here, it's extended, but over the past 4 days, it's actually been consolidating under a key level. And if we zoom in, we see it here. If we zoom out, we see this big formation here, right? And there's a high right here. And I think if Okta breaks through this, it's really going to run. And notice the good accumulation through this period in the CMF indicator, which is a money flow indicator. And now it gets even better when we pull this thing out and we see what's really developed here. This entire market cycle, we have an all-time high here around 300. There was this huge move down, right? And we had a bottom formation. We have accumulation coming in here telling us that institution and buyers saw value in this period. And then we have a big cup and handle potential breakout. So this fits the parameters on a kind of a short-term cycle, intermediate term, and then long term, we have this big old cup and handle, and if this thing breaks, there is so much room on the upside for it to run, right? And we don't have to worry about earnings for about another month either. And we could see an earnings run up as well. So I forgot what question I'm asking. It's kind of a combination of the comfortability question and your question about adding positions when you're super extended like this in the market. You want to slow down, and the positions you want to take have to really scream out at you that there's a reason to enter. And that's why we entered Octa here on this kind of anticipation of a breakout. And then when you enter, you need to use a little bit of a loose stop, which means you have to position size a little smaller. So think about what happens here. This is a great stock. I'm feeling in a few weeks it's going to be higher than where it is right now. But in the meantime, what I don't want to happen is to get chopped out because the market pulls back some, right? And if the market pulls back some, there's a good chance your stock is going to get pulled. Your stock is going to pull back as well. So I used a pretty loose stop under the 9 EMA here to allow some back and forth here if the market does pull back. So you have to factor in the market here. Like, okay, the market's extended. I have the stock I love. I'm going to enter it with a smaller position size and use a looser stop. So if the market does pull back, I'm all right. I have to be patient and kind of hold through some stuff, but it'll protect you a little bit in that regard. Brent, yeah, you definitely could see that happening. Daniel's asking, what's the website? You can send me emails. Take a snapshot right here. singjd1@aol.com. You guys can email me anytime. We're going to get to the review of these in a second here. You guys can email me anytime. Check out these posts on Bulls on Wall Street. 51 tips. I'm actually going to put this in the chat here. I think you guys will find this blog post really helpful. Just a lot of little tips here that if you read through these and implement these, it'll impact your trading. Then on my own site, Paul J. Singh, take a look at this recent article on the bear market top and also trading high quality setups. I think you'll find those helpful as well. All right, let's get to, I think that's it for the questions. Anu is asking, if the market is so extended and you foresee volatility, why are you going so aggressive with your positions? I think this is a mischaracterization of what I'm doing and what I said. The market is extended, yes. So I agree with that. I didn't say I foresee volatility. We talked about volatility tightening some here and kind of getting back to normal. So I don't necessarily see volatility. And in terms of aggressive, what I mentioned before is I've been taking profits as the market has been getting more extended. And when I've taken positions, I've used looser stops and smaller position size. All right. Jim, a link to here, I'll just post this stuff in the chat here. And then we'll get to the analyzing some of these stocks here. Okay, you've got some of these links in the chat here. Let me put the 51 tips. This is a good article here to go through as well. And just go to Paul J. Singh and you can just click on this here. That one's easy. All right. Okay, let's get to the Magnificent Seven now. I rather say big tech. I don't like calling them the Mag 7. I actually despise a few of these companies, so I don't want to call them magnificent. Let's start with Google here. Google has been in an ugly downtrend. I was even drawing out a topping pattern and saying if on earnings it breaks through this level here, we might look to short it. It actually did have good earnings. So you can see the earnings gap up here. Pull back to the 9 EMA and now is back over the 50-day moving average. Overall, not the nicest pattern, but if we just zoom in here, had good earnings, is breaking a key level. We could target the 200-day moving average around 172 and enter here around 164 and get a decent 2-to-1 risk reward. So I think Google is okay for an entry. My favorite of all of these right now is Netflix. Problem is Netflix is just way too extended. The market's gone up 9 days in a row and Netflix has gone up way more than that. And you can see this was the all-time high breakout. I'm waiting for a pullback on Netflix. And, if this gets even super extended, I might even consider a quick bearish play on it, even though I love the stock. But definitely, if this thing pulls back to the 9 EMA and shows support or the old high and shows support, I would enter that. Amazon, you can see here, has had fantastic revenues growth. Their guidance is really good. Had a really deep pullback, and maybe the overall pattern is not there yet, but had very good earnings, and you can see it gapped up on earnings as well. Has some overhead resistance here. I would watch this one for a move above the 200-day moving average. If it gets above the 200-day moving average, I think it's a slam dunk entry. Like, so watch this one around 200. If you're kind of a gambler a little bit and you want to take a small risk, maybe play it here and kind of play for that breakout and kind of before it happens. Apple had the gap down, nothing to do with it right now unless it improves. But for now, Apple's off the table. Microsoft was one of the ones that was the worst in terms of overall pattern, was looking very toppish. Look at all this distribution, all these big red candles telling us institutions were getting out of this stock. But with earnings back on trend, still not a great pattern in that it's gapped into a resistance range. And this is another one where you can wait for a break to the all-time highs or try to anticipate it, just take a little risk, a smaller position size than normal, and play it from here. Tesla, this one was getting crushed, and this one's really interesting. And this is a lesson we talked about in the swing service, and that is when you have earnings, and based on those earnings and based on the guidance, you expect the stock to do one thing, and it does the total opposite. That's a clue to go in the direction of the opposite that it did, the price, what the price action is doing, rather than what logic tells you. And that's hard to do when your mind is telling you one thing, but price action is telling you something else. So, for example, Tesla had, I think, the worst earnings it's ever had in terms of revenue growth. I believe the number is their revenue growth, their revenues compared to last year were down 70%. Earnings were down. People are not buying as many Teslas as they used to. And if you know that, and if you hear those numbers, you would expect a humongous gap down, right? But that's not what happened. Tesla actually went up. And that's based on two things, I believe. One is CEO Musk kind of toning down what he's been doing and getting out of Doge and saying he'll focus more on Tesla again. So the market likes that, related to Tesla specifically. And in their guidance, they came out and said they're on track for developing their or releasing their lower cost cars. And they think that will spur more buying. So those two things, regardless of what the actual numbers are, have the market anticipating something going forward. So even if your mind tells you these numbers are horrible, the stock shouldn't be doing this, the fact that the stock is doing that should get you very interested in the stock. And if this thing gets up over it's having a hard time breaking the 200-day moving average, but if it breaks the 200-day moving average, I will probably get in. The same thing happened with us. We traded Spotify, and we got out of that one very quickly. But Spotify had terrible earnings. And notice here, it did gap down, but it reversed very quickly. It made a low here of 540, 538, when the previous day it was sitting at 600. So it was down 60 points at the open. But then reversed intraday, and here's what it did the second day. Completely reversed what, again, logic would tell you. And when we saw that, we entered here on the break of the 9 EMA. And then on Friday, when it hit the top of the range, we got out at about 540. It went all the way up to, I think, 640. Went all the way up to 650, I think. Yeah, 651. But these two stocks, Tesla and Spotify, are really good examples. And this happens maybe 5 or 6 times a quarter, where a popular stock that you see has horrible earnings. You think it should be gapping down, but it does the opposite. When it does the opposite, I almost don't even think of patterns. I don't think of setups. I just jump in those things because it's so, that move is so powerful. So where were we? Mag 7. Okay, Tesla. We're watching the 200-day moving average there. NVIDIA has not reported yet. Doesn't report till later in the month. Meta, I like Meta a lot. This one, we talked about this on Friday. When I entered Okta, I only wanted to enter one stock because the market's extended. But I was deciding between Okta and Meta. I went with Okta, but Meta is valid as well. Had fantastic earnings after a deep pullback, but overall still fantastic trend. And while it pulled back deep, money flow has still been strong. So that's a good signal, even if you get up a deep pullback, that the institutions aren't pulling out. And then gapped over the 200 and the 50-day moving average. So I think if you're looking at any of these guys to enter right now, Meta is the one. Maybe Google as well. And Tesla if it breaks the 200-day moving average. But I think my favorite out of all of them is Meta. Think about the risk reward. You could enter here at 597, place maybe a say a little. It sounds like a lot because it's almost 30 points, but that's on a $600 stock. So it's like using a $3 stop on a $60 stock. So not that wide. But then if you target the top of the range, you're risking 30 to potentially make almost 250 points. So that's an amazing risk reward, right? If you were going all the way to the top of the range, even if you just went to here, you're looking at potentially, well, that would be 2 to 1, 2 to 1 there. But very good risk reward here. So I like Meta a lot of the Mag 7s. In terms of stocks on watch, we traded all these stocks through this period and we're profitable on all of them. And PLTR was one of the big ones for us. We entered this one around 77. There we go. You can see where we entered the rubber band setup with the market, and it was showing relative strength to the market, and we got out at 119. So a huge move here. But I still love the stock, even though we're out of it now. And you can see it's breaking the highs now, close to highs now. I think if we got some consolidation here and then a break of the high, that would be a very good potential entry. If it pulled back some and found support somewhere, that would be a good entry as well. We just got out of DoorDash, and you can see here it's breaking this range, but we had to get out because earnings are coming up. But I do like this as well. And if it were to break out to highs on earnings, I think we'd have a setup there. We got out of Roblox as well. And now Roblox is testing I don't think that's not its all-time high, but this recent high here. If it were to consolidate here and break this range, I think we have a good entry, potential entry in Roblox. And we'll go over one more. SFM. This has been one of my favorites. Sprouts in terms of relative strength. And you can see this fantastic trend, still really good accumulation, even though the trend has been going on for a while, and now testing the all-time high again. And when this thing breaks out to all-time highs, it tends to make very strong moves. You can just look at the past trend, and almost every time it's dipped and then made a all-time high breakout, it makes these huge runs. Look what it did here, what it did here, same thing here, just over and over again when it breaks to those highs. So maybe even an anticipation play here for an all-time high break. All right, guys, you guys know I run the swing trade service at Bulls on Wall Street. You can either join, and there's some discounts as well, or just do the 14-day free trial and get a feel for it. And you'll get to hear me talk about the market every trading day, of course, and we have the video reports and the chat room as well. If you guys have any more questions, you can ask them here. Daniel and R&B are both mentioning that Netflix has these ETFs. Yeah, for those of you guys who don't like trading a $600 stock, which I understand, or here with Netflix, $1,100 stock, remember one thing. These things also are moving by percentage gain, right? So even though it's 1,100, recently it went from 800 to 1,100. So even if you have 5 shares of it, you're getting the same or a bigger percentage gain than you would with the smaller stock that is not making as much of a percentage gain. That being said, it's still tough to trade sometimes when you have a smaller account. Plus, it takes up a lot of your account. But these big 7 stocks, I would have never imagined this, but now they have their own specific ETFs just for them. So R&B and Daniel are mentioning with Netflix, it's NFXL. So here it is. And you can see now it becomes a $56 stock. Not only is it a $56 stock now for you to trade, it's also leveraged. So you get 2 times the leverage. So when Netflix goes up 3%, this thing's going to go up 6%. That's great when it's going up, but it's also when it's going down, you're getting that extra leverage, right? So if Netflix is down 5%, you're going to be down 10% on this. But all of them, you can look them up, but all of them have these leveraged ETFs for the stock itself. Aaron's asking, what type of monitors do you have? The monitor you guys are looking at that I'm looking at right now is, I think, 32-inch. And I like that because then I can put you guys see the big screen here, but I'll like do multiple screens back and forth. And sometimes I can get like, instead of having a bunch of, I hate having a bunch of monitors. I just like, I like having essentially my computer hooked up to this. So I have two screens, and then my broker is on a separate laptop that I do nothing with except for having my broker up. So you could do it that way. You can use smaller screens and use multiple, some people do 5, 6 screens. I don't like doing that. I like to have one giant screen. I can put as much up as I want. Have another screen where I have my other stuff set up, and then one specific gaming laptop specifically for my broker. All right. Richard, that's a very good question. Do you hedge? I do hedge. I hedge with options more now. And for those of you who don't trade options, I would definitely learn options, and I can help you with that as well. If you have any questions, shoot me a message. You guys know my email. And actually, in that swing class, they're so important that I'm teaching a swing class right now. Tomorrow's our last session, and I'm going to get into options in that swing class tomorrow. Because it opens up a world of things you can do that you can't do just standard trading. I know options can be scary. There is a learning curve, and you hear the horror stories with some people who trade options. The horror stories are only because people don't know what they're doing. If you learn it and know what you're doing, it actually makes trading safer for you in the ways you can hedge, in the ways you can limit your risk. So there are some option strategies you could definitely use to hedge. You also mentioned UVXY. You could put on a VIX. A small VIX hedge is really powerful because you can take a small position and it can actually protect you a lot, because if the market tanks, that small position will be really big because the market tanked a lot, and now that can protect you as well. So yeah, I'm not hedging with UVXY, but I do have some options things that I'm doing to kind of help me as well. Richard, actually, I didn't start trading options until about 6 years ago, and I went through a lot of the popular books, and most of them are trash. They really are. There's one book that I found really helpful, but you're gonna feel like you're in college. It's like one of those math textbooks. I forgot the name of it now. I think I have it in my cabinet under here, but I'll look it up and remind me. Maybe just email me and I'll send that book to you. But most of it I did through kind of trial and error. But ask me some good strategies, and I'll mention them to you as well. All right, guys. Covered a lot today. I think we can, unless something changes, our attitude to the market is much different than it was a month ago. So do your research, get ready for Monday. I think it's going to be a big week this week. And then I will see you guys either at the next Stocks and Coffee, or those of you guys are swing members, I will see you guys on Monday. Talk soon.